Okay, good morning, good afternoon, good evening, depending on your time zone, and welcome to today's session. Today we're looking at understanding company finances, and I am Andy. I will be your moderator today. I'm afraid to say I have to share with you a fairly unpleasant picture of me. That's me on the right. On the left is Paul. He's today's speaker. He'll be the one talking you through the financial elements that we're going to discuss. Just a quick user guide help. If any of you have any problems, technical or otherwise, or any questions that you'd like to ask as we go, then please use the chat box on the right-hand side of your screen. We will be having a question session at the end, and so it's possible that some of your questions that you type as we go will get saved till the end, but if it's a burning question, then please at least feel free to type it in. So, as I said, I'm your moderator. Paul, I will ask to introduce himself in just a second. But if anybody has any questions, then please do ask away in the chat box. Good. So this is the overview of the session today, and I'm going to ask Paul to introduce himself and introduce the session. Paul, over to you.
Thanks, Andy. I hope you can all hear me. If I could just get a signal from IMechE that I'm audible.
Audible to me, Paul.
Okay, great. Thanks, Andy. There have been moments when I've spoken for about 2 minutes to myself on these kind of events. So we're going to look first at the main financial statements. That's profit and loss or income statement and balance sheet or statement of financial position, as it's now called. I'll just take you through the components of those and where those components come from. We'll then spend a little bit of time looking at some of the most important ratios that you're likely to encounter: return on investment, the relationship between debt and equity, and cash flow and working capital management. What I'll also spend a lot of time talking about throughout this session is how the accounts can mislead. It's important to recognize that when people talk about hard numbers, there's no such thing. There is so much interpretation that goes on that it can be very dangerous relying on figures in the accounts to make decisions. We'll look at required rate of return and shareholder value, which are non-accounting financial approaches, and I'll explain what I mean by that when we get there. But it's essentially the accounts are a transaction recording system. They are useful to measure performance over a year, say, but when you're looking at a project that may last 10 years, they're not so useful. Or when you're looking at how to invest in an intangible such as training, the accounts can definitely mislead. So that's a kind of brief overview of what I'm going to cover. I should say at this stage that this session and of course the 2-day finance for non-finance workshop that IMechE hold is not going to turn you into an accountant. I mean, you frankly as engineers would be insulted if you were told that a 2-day engineering for non-engineers course would enable people to go out and start designing engines. Clearly that's not the case, and so my focus is not to try to turn you into a below average accountant. It's to help you to make better business decisions, to understand how the measures are used, how they come about, so that you can then make better decisions. But we're not going to look at the intricacies of taxation, and so on. It's a top-level commercial manager perspective that we're looking at. Okay, so let's get into it. This is how you might feel during this session, and certainly during the two-day finance course. Generally what happens is there's information overload, and that's simply because there are so many jargon words that are used in finance that you can't quite remember things, and that leads to confusion. So generally what happens in the finance course is that you kind of feel less confident, and then you start to see how things fit together, and then it becomes much easier. It's a little bit like putting together a jigsaw, I guess, but when it's all the pieces are laid out in a mess, you don't kind of really understand it, but as you start to put the sides in and things start to fit into place, and that's kind of what finance is like. Okay, so we're going to start with something really simple called cost volume profit analysis, CVP. And in the old days, you might refer to it as back of a fact packet calculations. It's the kind of calculation that you might do to decide whether you should invest further effort and time in a possible business project. So basically net profit is sales less costs. But we can break the costs down into variable and fixed. So you're probably wondering what the eggs are there for. Well, if I'm a shop making pancakes or omelettes, then the variable costs are the eggs. And the definition of a variable cost is it's a cost which rises with sales. So it's tied to the sales, because clearly all costs are variable to some extent, but your rent, for instance, doesn't change with how many pancakes you sell, but the cost of the eggs does. Your phone bill doesn't go up if you sell more pancakes, but the cost of eggs does. So you can see that there is this distinction between variable costs, which vary with the number of units, and fixed costs, which don't. And fixed costs are sometimes known as overheads, sometimes known as expenses. So we can break that down into a transaction contribution. Now, this bit of jargon here, contribution, is another word for gross profit. That's what most people would call gross profit, and it's the difference between what you sell something for and the cost of the materials generally for that. So if I am selling an omelette, it's what do I sell it for, less the cost of the eggs and whatever other ingredients. Then I can and the reason it's called contribution, by the way, is because it's a contribution towards meeting your fixed costs, your rent and phone bill and so on. So if I then multiply the unit contribution, the transaction contribution, by the number that I sell, I get the total contribution, or total gross profit. And if I then take off my fixed costs, then I'm left with net profit. So that's relatively simple. So I'm just going to give you a chance for a little bit of brain exercise. So let's imagine that you have identified that there's the opportunity for a little side gig, a little business that you can run alongside your normal work, importing trampolines and then selling them on eBay. So the cost of a trampoline is £50. It's going to cost you £2,000 a year to store. It's going to cost you insurance of £500 a year. There are going to be miscellaneous expenses such as phone and so on of £500, and you reckon that you can sell on eBay for £90. Okay, so what would your profit level be if you were to sell 50 of them? So just have a think about that, and then just drop your answer into the text chat and don't wait for everyone else to do it. Very quickly, what do you reckon your profit would be if you were to sell 50 trampolines? Who's going to be first to get the answer? I know engineers are good at maths, so this shouldn't be too much of a challenge for you. But you're probably waiting for other people. This is like going to a stand-up comedy gig and where they involve the audience, isn't it? You don't want to sit in the front row. Aaron, excellent. You're absolutely right. That came to me privately. Neil, you're right. It's £1,000 loss, precisely. I'm just going to share my screen with you now, so that you should now be seeing the answer. I can't at this moment see the chat box, so if you're typing in your answers, I can't see that. So you can see here's the selling price, here's the cost price, the unit contribution is 40, we sell 50, total contribution is 50 times 40 is 2,000, we take off the fixed cost, which is the lockup, the insurance and miscellaneous expenses, and we're left with minus 1,000. And if we were to sell 75, then you can see that we hit break even. We make 0 net profit. It's the break even. Now you will also hear terms such as margin or gross margin or contribution margin, and you calculate that by putting the contribution of 40 over the selling price of 90, and that gives us a contribution margin of 44%. So we know that if we know what our sales are, we can multiply our sales by 44% and we will have our contribution. And we could have got to our break even of 75 very quickly just by dividing fixed costs, 3,000, by unit contribution of 40, and that gives us 75, which is the break-even quantity. And if we want to know the break-even sales level, then we divide 3,000, the fixed costs, by 44%, and that gets us 6,750. That's the level of sales we would need to break even. And you can see here in Excel that what I've done is I've just dragged across this calculation, and then I can start to play around and say, well, what if I was to maybe drop the selling price from 90 to 80, but I was to then sell 500? What would my profit be? And it's, as I said, it's this back of a fag packet just to get a feel for the business. And if I was seriously considering this, I would look at my quantity sold at 500 and I would say to myself, okay, that's 10 a week. Does that seem reasonable? I would, of course, have to think about, would my storage unit be big enough, so maybe I'd have to increase the 2,000. But this just gives us a feel for the business. Okay, so that's what's known as cost volume profit analysis. In the 2-day workshop, we go into this in a little bit more detail because there are certain costs, and I'm sure you've encountered them in your business, which remain fixed for a while and then suddenly jump. So a typical example of that may be where you have a field sales engineer who is maybe going out doing repairs to things. Now, for a given level of sales, you need 1 engineer. But if you increase sales just by 10%, you now need 2 engineers. And that's what's known as a step cost. So the fixed costs suddenly jump by an extra salary, and that extra salary may be less than the profit you're making on your additional sales. So you can actually expand the business and lose money. So you do have to be aware of what I call step costs, where you pass a threshold and suddenly there's a jump in the so-called fixed costs. Okay, so this is the financial cycle. Now what we just looked at with CVP is essentially the profit and loss account, the income statement. So I just now want to show you how money flows through a business. I think I can paint on the screen here. If I just click this. So we begin here with investors. So investors put money into the business, and that money becomes obviously cash. They may also decide to take out some long-term loans, which adds to cash. So now on the balance sheet, and you can see that the blue boxes of balance sheet entries, we have an asset, cash, but we also have liabilities. We owe the bank or whoever gave us the loan, and we also owe the investors the money that they put into it. Now it's obviously different, that money, in that the investors can't have their money back until the business stops trading. So if you like, they've loaned their money, but it's tied up, and it's this notion of limited liability. Business, or the owners of the businesses, are liable to the amount of money that they put in to the business. So if they put in £5,000, then if the business hits difficulties, that £5,000 can be used and given to creditors. But no more than that. That's the limit of their liability. Okay, so now we have liabilities on one side of the balance sheet and cash on the other side. So the balance sheet balances. With that cash, we can buy some assets. So we've converted one asset, cash, into another asset, PCs or machines or cars. We also buy some stock. So all this is assets. Cash has gone down but has been replaced by other assets. Now we start to use some of this stock to create goods. So we're going to convert stock into materials, and that's when it hits the profit and loss. This is part of the stuff that we are using to create goods that we will sell. So we produce the goods and we will make sales, but we've also had some operating expenses too. So we've had to pay some salaries, we've paid energy, we've invested in marketing. So there are operating expenses, and this bit here in the red box is what you just looked at with the cost volume profit analysis. That's essentially what the profit and loss account is. However, when we were trading, we didn't pay for everything up front. We got some credit from our suppliers. So that's another liability. It's a little bit like the long-term loans. We owe some people some money. We also have money owing to us. So when we made the sales, we gave some credit to our customers. They didn't pay us immediately. So that is an asset. That is money that is owed to the company and will eventually come in. And those are on the balance sheet, as you can see, because they're blue boxes. Now, at the end of the year, we have hopefully made a profit. And we have a couple of options with that profit. We can either pay dividends to the investors, and that is money that is going out of business. So once the shareholders have that dividend, it's no longer available to the company. It's being given back to the owners of the company. It's their money. This retained earnings is money that is retained by the business. Now, it still belongs to the investors. It's just that we haven't given it back to them yet. So if you were to look on the balance sheet of your company, you will probably see a figure for retained earnings, and it's a cumulative figure. It's all the money since the day the company started trading that hasn't yet been given back to shareholders. Okay, so it just goes up each year, and if a dividend is paid, then that doesn't get added to retained earnings. Now, you may wonder how a business can pay a dividend in a year when it makes a loss. And the reason it can do that is because it can go into the pile of retained earnings that have accumulated from previous years and give that back to the investors, because after all, it's their money. Okay, so the profit and loss, you might be thinking of that as being like a pile of cash at the end, and that this is an easy confusion to make, but it isn't. You may have no money in the bank and have made an enormous profit. Why might you have no money in the bank? Because you went out and bought some more PCs, you went out and bought some stock, you gave credit to customers. So one of the kind of most difficult things for people to grasp who are non-accountants is this idea that you can make a profit and have no money. But it's a critical thing to keep in mind. Okay, so I'm now going to just move into looking at the income statement and take you very quickly through it. Income statement, more commonly known as the profit and loss account. At the top you have sales or revenues, and I've got a little note here on IFRS 15. This is the International Financial Reporting Standards, and these are a set of principles / rules. I say / rules. They pretty much, if you fall foul of these, your account's not going to be signed off. You may even be breaking the law. So they're being decided by the accountancy professions around the world, hence the international part of it, and they're steadily replacing country-specific accounting principles, because obviously we're living in a global commercial world now, and it just adds to the confusion if a company's accounts are being drawn up according to different principles depending upon which country you're looking at. So it's a work in progress, these international reporting standards. One that has come in at the beginning of this year is IFRS 15, which relates to revenue recognition, and it's basically concerning when does a sale get recognized as a sale. And you may think, oh, well, that's fairly obvious, and it is in most cases, but if you think of an engineering project that is maybe spanning several years where there are staged payments, then you can see that the whole value of the contract is not recognized immediately. There will be staged payments. Now, the staged payments are a good indication of when revenue will be recognized, but they're not necessarily always valid. You could, as an organization, make the staged payments be timed very carefully so that they fall in one year rather than another. And if they fall in a later year, so maybe in April rather than March, they don't get included in this year's profit and loss, and that means you pay less tax, which is why IFRS 15 is there to say, hang on a second, yes, you may be only getting paid in 3 weeks' time, but we reckon value has already been transferred to the customer and that is what we're going to assess you on. Okay. Again, on the 2-day course, we'll cover that in a little bit more detail, and I'll give you some examples. One interesting example is about mobile phones, how the handset used to be treated by the operator as an expense, which they would claim back immediately, but they wouldn't claim back the value that the consumer received immediately. So they were kind of, having the cake and eating it, and that's all stopping. I've just seen a question from Andrew in the chat. WIP is work in progress, and I'll get to that in a moment, Andrew. Okay, so IFRS 15 is revenue recognition. Then we come to cost of sales. So this is the costs which are related directly to the sales which you have made. In other words, the costs which you wouldn't have incurred if you hadn't made those sales. You will sometimes see it written as COGS, cost of goods sold. You can see it written as variable costs in your management accounts, and you may even see it as direct costs. So what's the difference between those? Well, cost of goods sold is basically only those costs which are directly related to the materials involved in the production of the product. Direct costs, you may include the costs of engineers, salaries, people on the production line, and so on, because they are directly related to the production of the item, but you wouldn't include the salaries of accountants and HR people because they're not directly involved. Now there is some things that you have to do when you draw up not your management accounts. Management accounts are internal accounts that are used to help manage the business, and you can basically do whatever you like there. But in your financial statements, the accounts which are public, which are going to go in your annual report and which are going to be used to assess your tax liability, then you have to follow certain rules. And the biggest one, I guess, for engineering organizations is going to be how you treat stock. And it's a little bit too complex to go into right now, but basically, if you have, going back to what Andrew was asking, work in progress, you have to add some of the costs of producing the work in progress, and those costs will come off your overheads. So you can't claim them this year. They get added to the value of the stock and become an asset. And what this is really about is just making sure that you pay tax earlier, that you pay tax when it's appropriate, and don't try and claim back more expenses than you should really be claiming back. And it's ultimately comes back to a fundamental principle called the matching principle in accounts, which is that expenses should be related to the sale, should be linked to the sales to which they relate. Okay. Okay, moving down, we've got contribution or gross profit. In the US, it's often referred to as gross margin, whereas in the UK, when we see margin, we tend to mean a percentage. Then we take off expenses or fixed costs or overheads. You can see this jargon. You've got 3 different terms, at least, for the same thing. And this is, why people are sometimes a little confused by finance, simply because it's so jargon-laden. But, in defense of the accounting profession, so's every other profession. It's a kind of conspiracy against the layman. And then we get down to net profit. Now, you will often see net profit written as EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. So the first four are relatively easy: earnings before interest and tax. So we haven't taken off the interest and tax yet. Why not? Because we know that what we want to look at is how the business is performing as a trading entity. We don't want to be concerned about how it's funded. In other words, is it funded by loans where you pay interest, or is it funded by investors where you don't pay interest? Saying, look, let's just ignore that part. Let's ignore taxation, because we know the tax calculation can be quite complex. Let's just focus on the trading position. Then we take off depreciation, and depreciation is an accountant's way of spreading the cost of an asset over its useful life. So if you buy a computer for, let's say, £2,000, and it's going to last you for 5 years, then it wouldn't make sense to claim all that back in the first year, because you're going to be using it for the next 4. So this year looks terrible, the next 4 get a computer for free. From a financial perspective. So in simplest terms, what you would do is you would take the 2,000, you divide by 5, and you take off £400 this year of depreciation, and 400 next year, and so on. And that's known as straight line. There are other approaches, again, which we'll cover on the 2-day course. Amortization is similar to depreciation, but it's of an intangible. And an intangible typically is something like a patent, or research expenses, or goodwill when you buy another organization. So what we're saying is, look, let's just ignore the ITDA for now so we can focus on the trading. So it's sometimes referred to as the manager's profit line, because it's the things that are not truly related to the trading performance. Okay, so the pension liabilities, Joe, would sit under expenses. Okay. So now we're going to take off the depreciation, interest and amortization, and we're left with earnings before tax. We take off the tax and we're left with earnings after tax. And then we take off the dividends, which we pay to the investors, and we're left with retained earnings. Okay, Ramon, very good question. Sorry, Ramon, you sent that to me privately, so I'm just going to read out what you said. How is the asset life of all assets in the company tracked to ensure that there are no accounting errors produced in the income statement? That is, an asset is not incorrectly depreciated. Okay, here we see one of the difficulties in the financial statements, that it's a question of judgment. How long is this asset going to last? 5 years. In the 6th year, you're still using it. So we've written it off. It's 0 in the balance sheet, and yet there it is churning out widgets. So this is something that the accountants will sort out at the end of the year when they do the audit. They may identify that the machine is still churning away at the end of year 3, and so there may be a revaluation of the asset, which would result in an appreciation. The depreciation is reversed. So the depreciation is one of those things which is tricky, Ramon, and if an organisation gets it wrong, their balance sheet can actually be make the company look worth a lot less than it actually is. And there used to be companies who would specialise in analysing balance sheets to identify assets which were undervalued, and then they would make a bid for the company, and then they would simply sell all the assets off and close the company down. It was known as asset stripping. Yeah, actually, what would happen is that it will be revalued. So if it's 0 at the end of year 10, the auditors would simply revalue it, and it would reappear on the balance sheet with its new value, and that value would be an appreciation. The guiding principle, Nigel, is the auditor's duty is to the government, to potential investors, and last of all to you, even though you pay their fees. So it's basically the financial statement should be a true and fair reflection of the business. So if there is a substantial difference, then you should revalue. But if it's, maybe not that significant, you wouldn't do it. It's always difficult because the value of an asset, if you think about it, it can be looked at in different ways. Is it how much somebody is prepared to pay for it, or is it how much is it worth to me? So I may have a machine that makes widgets that those widgets only fit in my product. It's useless to anyone else except scrap value. So what's the value of the machine? So, it's tricky. It's about true and fair reflection. And there will be, within industry sectors, kind of rules about how things should be done. Okay, I've got to move on a bit quickly here, guys, because I'm not going to get through everything that I said. So here you can see the balance sheet is like a photograph. It's a snapshot. The business is closed down. We've valued everything, and then we started trading again. And then again, we close down at the end of the next year, we value all the assets and see what the new values are. So the balance sheet, fixed assets. So remember, the balance sheet is what do I own, what are my liabilities? So we're looking at the asset side. What do I own first? We've got fixed assets, so tangible property. And fixed assets generally, what do you use to do what you do? I'm not going to look at the financial and intangible assets. It's just to say, there are other things. And the key, whether it's a fixed asset, is it going to be around at least longer than a year? If it is, it's probably a fixed asset. You're not going to sell it. You use it to do what you do. Now, leases are a complicated area, and it's all going to change. Leasing was a way of keeping assets off the balance sheet, so it looked like you were doing really well because you didn't have too much invested in the business and were producing high profits. But that was a little bit misleading, and it meant you couldn't compare apples with apples, because one company would be buying its production equipment, another company would be leasing it. But that's all changing at the end of this year when new legislation comes in. So that's why this slide is crossed out, just to say it's changing. I'm just going to go back a slide. Firstly, Joe's question, which was, where does the intellectual property sit? Well, it depends what that intellectual property is. If it's simply, we know a lot of stuff, we're clever people, we've produced some reports, it doesn't sit anywhere. And this again is, how much is a business worth? Is it worth the assets on the balance sheet, or is it worth something else? And intellectual property is one of those strange things. You can see that if you're buying a consultancy, then the intellectual property is really why you're buying it, possibly. But it's not likely to be on the balance sheet. Why? Because you haven't paid any money for it. And the accounts are a transaction-based system. If there's a transaction, then I can get it into the accounts. If there isn't, that's very hard. So an illustration is, if I say to people on the course is, what's the most valuable asset your company has? People would generally say the people. But the people aren't in the balance sheet. The skills, the relationships you have with customers and with suppliers, they're all valuable. And that's what people will pay for when they buy an organization. Okay, now that lets me answer Trevor's question, which is, what is goodwill? So Trevor, goodwill is, if you buy an organization, the value of its balance sheet, let's say, is 100,000. And that is, in accounting terms, is what the business is worth. But we know, because of all the intellectual property, the relationships, the brand, and so on, you're not only going to pay 100,000 for it, you're going to pay, let's say, 400,000. So now you pay out 400,000, but you only get coming into your accounts 100,000 pounds of value, because you're simply adding the balance sheet of the company you're buying. So there's a 300,000 difference, but you must have paid for something. So we have this entry called goodwill. Goodwill is a really interesting area. It links into brand, and again, we talk about it in more detail on the 2-day course. I'm going to have to move a little bit quickly. Daniel, leases are a little bit complex, I'm afraid. So come on the course. Okay, current assets. So we've done fixed assets. Current assets are assets which can be converted into cash easily. So it's obviously stuff that already is cash. It's stock. It's money owed to you by your customers, accounts receivable, and things like that. So it's stuff that's going to be turned into cash quickly. That's one side of the balance sheet. On the other side of the balance sheet, you have the money put in by the owners, the investors. And added to that are the retained earnings, the money that the company has made as profits that haven't been given back to them yet as dividends. Who else can it belong to? It must belong to them. We have long-term liabilities. So again, it's this period of a year. This is loans that are not repayable in the next year. I won't talk about these things here right now. It's loans which are the important one. So we've got loans. And then the final liability is current liabilities. And again, the focus is on within a year. So when you see this word current, it means within a year. So this is money that you owe to your suppliers, accruals, which is money owed at the year end but not yet recorded in the books of accounts. In other words, you haven't received a bill from somebody, but you've obviously had the value, so we need to take that into account. Okay. So this is what the balance sheet looks like. It has the assets on one side, liabilities on the other side. You would sometimes see it at the top of this side, financed by, because this is where the money essentially came from to get hold of this lot. Sorry, my slide isn't moving forward. There we go. Now, often you will see that current liabilities moves up here to underneath current assets. And the reason is that we want to know what this figure is, the difference between these two, because this is the short-term position. Current means within a year, so cash that we will have in a year, cash that will go out within a year. That is the key thing that the finance department spend a lot of their time managing, because if current liabilities is bigger than current assets, you may be going out of business. You've got a cash flow problem. This is work in progress. Sorry, notice it's working capital. This is working capital. This amount, this is the amount tied up in the business that is funding, that is, like the oil in an engine. Okay, I'm just looking at my watch. I'm going to skip this bit simply because of the question of time. So there are decisions that in the short term look good, but in the long term look bad. So just have a think about what those might be. Let me give you an illustration. You're the new chief executive, or maybe the manager of a division, and you want to look good. So what you do is you cut all training, you cut all marketing. Now those are expenses. They come off this year's profit and loss. But we know that training and marketing has an impact over a longer period of time. So if you were to stop all marketing this year, your sales probably would be okay. It's what happens next year where the issue comes in, and the year after that, and the year after that. Similarly with training, if you don't keep your skills base up to date. So this year, profits look fantastic. Wow, what a great guy this is. It's the following years that the problems come in. And this is why when people talk about hard numbers and looking at the accounts, it is so important to push back and say, look, the accounts do not give the full picture. They can lead you to make short-term decisions which make you look good but actually destroy the business. So typically, when we're looking at a business, managing its performance, we look through a number of different lenses. One is profitability, one is liquidity, in other words, have we got enough cash, and another is financial status. And we look at this in depth on the 2-day course, but what I'm going to do now is just look at a couple of the important ones. So return on equity is the money that the company has generated as profit, the earnings after tax, expressed as a percentage of how much of the owner's money we had. So this is basically saying you had this much of my money and you returned this much profit. So you made me a 4.9% return. Now you're probably saying, okay, what's the horse about? The horse is basically saying, if you look at the percentages, and you can go to the Financial Times and you can see the return on equity of lots of companies, you may say, well, why don't I just, I'm getting a message here that audio's dropped out. Can other people still hear me? Okay, Ian, if you can hear, the problem's yours, I'm afraid. I'm going to carry on. What we're saying is 4.9% good when I can get 20% from this company over here. But the reason you can get 20% from the company over there is it's probably a bit more of a risky company. In other words, if you bet on the favourite, then you're happy with 2-1. But if you're betting on a rank outsider, you'd want 100-1. So basically, investors trade risk for return. If you're a risky company, I want a bigger return. Otherwise, why would I take the risk? Return on total assets is more of a manager's. So this is what you've had to use, the assets, and this is what you generated in profit. Okay, so that's a ROTA, return on total assets, is a typical KFI, key financial indicator for a manager. That's a very good question, Apostolos. I don't honestly know. What I would advise you to do is go and have a look at Google Finance and just put in some of your competitors and have a look. One of the difficulties with consultancies often is a lot of them aren't publicly traded, the smaller ones. The larger ones are. Now, when you look at their ratios, what you find is there is an enormous array. And so this kind of ballpark figure, and I understand why you're asking it, is very hard to pin down. You can have two companies with very different ROEs that are still doing well. And the reason is because whilst one may be doing well on profit, it's not doing so well on cash. So you have to take, the reason why so many different measures are calculated is it's a bit like a doctor. You have to take more than one measure. You don't just measure the pulse, you take blood pressure, you look in their eyes, you look at the tongue, same in finance. Okay, I'm going to move past that. This, I say on the course, is the most important slide. It's about working capital, and it's basically about cash flow. So let's say you buy some stock. Now, on average, and you can do the calculation, which we look at on the course, you can work out that on average, before a finished product is created, the materials are in stock for 49 days. At that point here, on average, it's converted into a sold product. Now, again, you can work out how many days on average does it take for your customers to pay you. That's known as days sales outstanding or accounts receivable. In this case, it's 81. Now, when the stock arrived into your warehouse, the clock started ticking with the supplier that provided those materials. And on average, you pay that supplier in 62 days. So that means after 62 days, you have money going out of the business, but you haven't received the money for the goods that you've sold until here. So you now have a funding gap of 68 days, and that's what working capital is covering. It's the money that you need to trade in the way that you do. So how do you improve working capital? Well, you hold less stock. You get better credit terms from your suppliers. You get your customers to pay you earlier. Okay, so the key thing here is what many small companies make the mistake of is they get the big order from a major corporation and they think, brilliant, that's our sales for the year. But they don't realize that for every pound of sales, they're going to need, pennies worth of additional working capital to fund the gap between getting paid. And if you're dealing with large organizations, often you'll be working on 90 days, 120 days credit. But as a small company, you may have to pay in 30 days. So, the balance of power isn't with you. So you can have fantastic profits and be out of business before you ever see them. Cash is king. Okay, last ratio I wanted to look at is when debt replaces equity. So, if you imagine an organisation that has £100,000 in capital, now all that capital could have come from the investors. They put 100,000 in. But the investors say instead, no, let's put 50,000 in ourselves, and instead let's take out a loan for 50,000. Now, if you take out a loan for 50,000, you're going to have to pay interest on that loan, which means that your earnings after tax are going to go down because you're going to have to take out interest payments. Okay. Let's have a look at what that means in reality. So here we have equity 50. Now we're making a profit of 20 and debt is charged at 10%. Now, with 100% equity, we have no debt, therefore no interest. Therefore, we're dividing 20, the earnings before tax, by 100, which gives us a 20% return. Now, if we, as investors, only put in 20 but take out an 80,000 loan, we'll be paying 8 for the interest, which reduces the 20 down to 12. And now 12 divided by 20 gives a return of 60%. So you can see that what we're doing is we're generating a bigger return for less money. And this is known as leverage. And if you have a mortgage, you're basically doing the same thing. It's a way of making your money produce more. And that's fine, of course, until you hit bad times and your profits fall to below this figure, at which point you can't pay your loans and you're out of business. So again, you can do this, but as you get this higher return, you're also increasing your risk. So again, what finance departments will spend their time doing is working out what's the balance between debt and equity. Okay, I'm going to have to skip this just because we're coming up on time. As I've been saying throughout, investors trade risk for return. I'm going to move past these just to get to my finishing remarks. Accounting profits encourage an excessively short-term view of business. They also encourage an underinvestment in information-based staff, brands, and customer and supplier relationships because those don't appear as assets. In today's information age, the accounting focus only on tangible assets makes little sense now that these intangible assets are the overwhelming source of value creation. The other thing to keep in mind is that when you're looking at the accounting statements, you're looking at the past. You're looking at history. Yet we know that these things here are what are going to drive future performance. So yes, if you're thinking of taking over a company, then you can see it's got healthy profits, but is it going to have healthy profits in the future if it hasn't been investing in those areas? So you have to use more than simply the accounting figures. And this is just summarizing this. This is from an article in the Harvard Business Review. The companies in our study that adopted non-financial measures then established a causal link between those measures and financial outcomes produced significantly higher returns on assets and equity over a 5-year period than those that did not. In other words, what they're saying is you have to find a way of linking these intangible drivers of performance that create things like customer awareness and so on, and link them to the financial response. We know that this is good, but we have to prove the connection that if we do this, it will lead to this. And this triangulation, if any of you are mountaineers, you will know that triangulation is how you can work out the height of a third peak if you know the height of 2 others. And that's essentially what we're saying. If we know that we spend money on marketing and customer awareness goes up, and then sales go up, we can start to establish a causal connection. So, that is a rush through. Apologies for the rate I was going at there. If we have any questions, please feel free to type them into the text chat. Okay, I've just got a question that. Oh, sorry, Andy, over to you.
Thank you, Paul. Sorry, I forgot. I've been chatting away. I forgot to unmute myself most professionally. So thank you very much indeed, Paul, for the session. Obviously, the volume of questions has meant we've overrun a little, so I just wanted to wrap up for those of you that need to rush off. Rachel, our host, will just post a link as to where you can find the slides from today's session, and in a few days' time you'll also be able to access a recording of the session. That won't be available immediately, but in a few days' time you'll be able to get the recording too. So I just want to draw your attention very quickly to some upcoming training that Paul will be running for us. You can see the sessions in the UK there, Glasgow, Coventry and Sheffield, on similar ideas, if not exactly the same. Financial management is in Glasgow. And also draw your attention to the webinar on the 20th of July on innovation and problem solving. Thank you all very much indeed for your participation and involvement in the session. For those of you that can, please do stay on. We will be here for another 15 minutes to answer questions. If you do need to rush off, I completely understand. We are 2 minutes over, so please do feel free to log off. But thanks once again for your attendance. Great stuff. Okay, so for those of you still here, any questions, then please do feel free to type them into the chat box. Now, Paul, be ready because I can't answer them. I wonder if actually going back to a comment from earlier about leasing, is that something you could deal with now, Paul? I know you couldn't at the time because we didn't have time, but is that too long a question to answer now?
It probably is, Andy, and it really needs figures to show how it's done. Leases have always been an incredibly complex area, and there is the new legislation is trying to simplify, but it's still not easy. The basic thing about leases, what is going to change is the only distinction between capital and operating leases is disappearing, and basically if you're using equipment to in your business, it's going to be on your balance sheet. Even if you're leasing it, it's still going to be on your balance sheet. It's simply about making it easy to compare how businesses compare with each other.
Okay, very good. Thank you. Thank you for trying to answer a complicated question. Perhaps we could handle Ashley's question about how companies handle WIP. Is it treated as an asset?
Okay. Yes, work in progress is an asset. So it's obviously different from raw materials, and the calculation for work in progress is basically how much has been used in creating that work in progress. So very simply, in principles rather than dealing in figures, if you have a machine that is producing, converting raw materials into widgets, then if you have a number of widgets left at the end of the year, you would add onto the cost of the raw materials an apportionment of how much of that machine's cost did you use up in producing those widgets, plus if there are people who are employed working on that machine, you would apportion some of their salary into the cost of each widget. So the work in progress is the raw materials plus whatever other costs you've had to incur to get the widget to its current state. Now what that means is if you're apportioning the cost of someone's salary, it means that the bit that gets added in WIP gets taken off your expenses. So what that means is your expenses are lower. If your expenses are lower, your profits are higher, you pay more tax. So that's why with WIP you have to add in those additional costs.
Interesting. Thank you, Paul. Have you seen the follow-up question from Ashley there?
Okay. 50%. That used to convert 50% to profit month end as contracts rather than that. Okay, that's probably something that was happening in your management accounts, Ashley, and as I said early, what you do in your management accounts is basically up to you. It's whatever helps you to make good decisions. What information do managers need? So I'm guessing that what you're saying is in the next month we will sell 50% of whatever the work in progress is. Therefore, we're going to add it into the profit. It will be slightly different at the end of the year when the auditors come in.
Very good. Thank you very much, Paul. Seems like that answered the question. Hope it did, Ashley. There's one up there from Jake, Paul, that I wouldn't know how to answer myself. Can you?
No. It's a fairly specialised area, Jake. I'm afraid that's beyond my expertise, and I wouldn't want to give you a simple answer because I'm sure you probably already know the simple answer. You were looking for more detail. Apologies for that.
Good. I suspected that might be the case. One there from Ali. Project finance, yes, would be beneficial also. Was that a question, Ali, or a comment?
I can go into that anyway, Andy. You're absolutely right, Ali. I was hoping to just tack it on a little bit at the end there, but as the topic or the title of the webinar was financial statements, that's where I focus my effort. But we do cover it. We spend quite a lot of time on project finance in the 2-day course, and we look at things like payback period, internal rate of return, net present value, and so on. You're right, it is interesting because it's a non-accounting based approach. It's a cash-based approach. And it's the only way you can really justify things like investments in intangibles, relationships, training, culture, motivation, and so on, and of course longer-term engineering projects.
Very good. Good. Okay, I think we've come to the end of all of the questions. If anybody's got one, fire it off quickly before we wrap it up. Otherwise, all it remains for me to do is to thank Paul once again for today's session. I hope you all found it useful. Glad to see you did, Ashley. And obviously to invite you to join us in any sessions that you think would be useful to you, in any training sessions. Please do get in contact with us. And you can see on the screen there's an email address for Paul if you would like to get into contact with him. Good stuff. Thank you very much indeed, one and all, and hopefully see you on the next webinar.
Cheers, everyone. Have a great weekend. Bye.